Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is the 2016 Roadmap to Succession Planning for Firms in the Southeastern U.S. Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. Under the new NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive your credits, you must complete two requirements. The first is that you participate in all 4 of the polling questions that we'll have throughout the presentation today. And please note that GoToWebinar does monitor your participation in those polls. We will be able to issue partial credit for those who answer 3 out of 4 of the polls. Online evaluation. This will appear on your screen right after the session ends, so please take a moment to complete that before you close your web browser. Once you've met both of the requirements, I will email your CPE certificate within 10 business days. Now, in order to fully participate in the webinar, please take a moment to familiarize yourself with the GoToWebinar control panel. You'll see it on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the panel if you wish. During the presentation, the participants are muted, but if you'd like to communicate with us to send us any questions, you can do so with the chat box. Time permitting, we'll answer any questions that come up today. Finally, I'd just like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. We have 2 remaining topics before we take a break for the tax season. On December 15th, we'll present the urge to merge, and then January 12th is Back to the Future, a look back at what happened and what we can expect for the new year. You can find more information about these webinars and register for them on our website, transitionadvisors.com, in the CPE courses section. Finally, I just want to remind everyone that you received an email from GoToWebinar that included a link to download the presentation for today. I just sent it again via the chat box, so if you'd like to download that PDF, you're welcome to. If you'd like for me to email it to you as an attachment, just reply to that email. That'll come directly to me, and I can send it back to you with the PDF attached. Now, I'd like to introduce our presenter for today's session. Marcia Miller is the Managing Director of Transition Advisors. Thank you so much, and I hope you enjoy the webinar.
Thanks, Nikki, and thank you for all of you who are on the call today, and I hope we can give you some valuable information on planning for your own firm's succession or for your personal succession, whatever that might be. You know, when we started out as CPAs, we didn't really think this day was going to come, but it's here. And when should you have started to think about succession? Probably the day you opened up your office. But many people don't do that for a lot of reasons. And depending on where you are in the country, there are different rules in doing this type of plan, and there's also different valuations around the country. I'm going to try and explain to you what succession would look like in the southeast part of the U.S. and what kind of plans you should make accordingly. Now, one of the reasons why we are seeing merger mania today is because a lot of firms want to grow, and the old way we would grow was one client at a time, you know, all those referrals and whatnot, but that could be a grind. Perhaps a certain CPA firm wants to develop only a marketable niche. Maybe it's in forensic accounting. Maybe it's only an audit firm. Maybe it's only HOAs, whatever it might be. Or maybe to grow, firms want to merge or acquire other firms because they were not able to open up those niches and get that many clients on their own. Now, there are types of mergers that are out there. There's what we call the mini merger, and that's when you add 1 to 2 partner firms with books of businesses. I know a lot of you probably have large firms, and when you look at the top 100 or the top 30 firms, how did they get where they were? They got there through these mergers, and a lot of them were involved in the upstream merger. That's usually where there's more than one deal at a time in that type of merger. And we have different types of accomplishing these mergers. Maybe you have what's called an immediate sale. Let's say the person has waited too long to put their succession plan into place, and now, for whatever reason, they want to leave now, or maybe their health is not that well, so they have to leave now. Then we have the two-stage sellers. Those are the parties who stay around for a little longer, but they start reducing their hours, and they want to be there for the retention of clients and getting paid for that retention. Then we have the merger for partners that aren't seeking succession or role reduction, and they may want to stay 6 years or more. And there are different reasons why we have these mergers out there. Could be financial. It could be that you need more support. Maybe you don't have, enough staff to do the kind of work that you have. Something that's quite often asked of me, is it a buyer's or seller's marketplace? Well, the old saying about real estate, location, 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 that is important. If you have a practice in a rural area that's very far from the city, your chances are you're not going to merge with a large city firm, and maybe you wouldn't want to because the chemistry would not be there. So if you're trying to merge and you're in the rural area, you're going to look for somebody in that type of area. And you'll look at the population there. You'll look at the size of the practices around you. Maybe you want to only merge with someone who has the same niche that you have. These are all reasons to add to the value of your practice in today's marketplace. Now, when we talk about succession, we talk about several challenges. And I don't like to give a lot of statistics out here, but I thought these were some of the most important ones out there. There are 80% of all the multi-owner firms expect their succession planning to be like the overwhelming issue in their lives over the next 10 years. Less than half of those firms in the U.S. have mandatory retirement guidelines. 61% of the equity owners are over 50. So, and all of us over 50, we are the baby boomers. Owner firms have a formal succession plan in place. That means a lot of them may have to put a plan in place before you firm about merging. You've got to get your own house in order, so to speak. For those firms that have 70% of them do not have a succession plan in place. And that's probably many of our sole proprietors who are out there. And speaking of sole proprietors, less than 6% of them have a PCA, a practice continuing agreement. Done your homework and you didn't put some kind of succession plan in place. Well, it's good that you're on the call today because at least you've thought about it and maybe you've seen issues that friends and associates have had in selling their business, and you want to make sure that if you are going to have a plan in place, you're going to get your worth for your hard equity, your sweat equity for all of these years. But keep in mind, when you're selling an accounting practice, it is really emotional. You've been with so many of these clients for years and years. It could be 40, 50 years. You've watched them get married, get divorced. You've met their kids, their grandkids. You've been to parties. So there's a lot of emotional attachments to doing this. So you want to look to do this and don't procrastinate. Because if you procrastinate, you could be like a client that I had that unfortunately after tax season wound up with a stroke. Yes, we sold his practice, but he wasn't there for the retention, for the succession, to make sure the clients weren't scared that this new firm has taken over. So you don't put off the process. Now, some things you should ask yourself every year. You want to know, what do your partners, or what do you feel are your retirement goals? Have they changed over the last year? Maybe it changed for different reasons. Your personal life, your health. Maybe you hit the lotto, and that God bless you, I hope you would. But anyhow, you also want to know, do you have the right staff in place? Maybe you want to put a succession plan together so that you can keep all these clients, but at least you have the right staff to do all the work that's necessary. You've worked so hard all your lives. You don't want to be working 70, 80 hours a week at this point. You know, I just recently sold a practice, and it was a sole proprietor, and he says, oh, I'm so happy that I sold my practice. I'm not working the hours that I worked before. My wife sees me every night for dinner. She never saw me. I was home at midnight every single night, and this was not just tax season. It was all year long. So I said to him, wow, how many hours are you working a week now that you feel like you're on vacation and you get to see your wife? He says, oh, I'm only working 50. I don't know if you want to do that when you're starting to retire. You may want to work 30 to 40 hours. But in his case, he felt that it was a great solution that he goes and sells his practice and merges with someone else. Some things you may also want to consider. Maybe you always wanted to have that second office on the other side of town. Maybe you had clients there, and it was inconvenient to go back and forth. Well, now, if you're merging with someone else, you're going to have that additional location. And if you have that additional location, maybe you'll get those clients that you couldn't get before because they said your office is not user-friendly. It's too far away, okay? Other things you have to look at, the economy has a lot to do with your decisions and what your local market is, what firms, what competition is there, and are they competing in the same kind of business that you are doing. Another thing to consider is, what if you lose partners or staff? I recently had a client that said to me, you're not going to believe what happened to me in tax season. And this is a large firm in South Florida. I would say they have about 50 employees, but they had a key person in tax season who handled their payroll division. That's a niche that a lot of CPAs are doing now. And that person had a car accident and was not around to do any of the 941s or any of the quarterlies, and he was in a lurch. Then there was another key person, a manager, tax manager, whose husband was in a car accident, and that person was not there. And then there was another one who had a heart attack. 3 different types of problems that created a loss of staff and significant staff that hurt this company. And so they're looking to merge with even more to have that additional capacity should something like that happen. Now, that's not the norm, but you got to prepare for it. Now, you know we're going to have a series of polling questions. We're going to start with this one, number 1. Nikki?
Okay, the first polling question is on your screen. This one is, how many equity partners do you have in your firm? And so your options are there, 1, 2 to 4, 5 to 9, 10 to 19, or 20 plus. And we'll give everyone just a few seconds to answer. And as we said earlier, there are 4 polls today, and this is the first of 4. So go ahead and close the poll. And Marcia, all of the folks on the call are sole proprietors.
Okay, all right. Gives me more of a sense of what to speak about or not to speak about, which is great. Okay. So if you're sole proprietors, and you're talking about succession, you're probably not looking to obtain another partner, so to speak. Maybe if you were in a firm where you had other partners, this would be really important. Hire people who are able to become partners later on so that they can take over your book of business, take over for some of those other clients that you wanted to have. But I think the people on the call today, if you're sole proprietors, you're not looking so much for a partner as you're waiting and looking to get out of your business and want to know the procedure. So how are you going to choose that person, that successor or firm that you're going to merge with? Now you want to know if that successor is ready. Actually, you may want, a big thing is you want to make sure they have the right staff with excess capacity. You want to know, why is it they're even looking to acquire your practice? Have they done this before? Do they have enough room for you in their offices? You may want to know what their tax software is. You don't want to learn something all over again. And if it's not what you have now, are they willing to take on the cost of transferring all your information into their practice? Keep in mind, when you merge with someone, bigger is not always better. Now, you as a seller, what are you thinking? You're probably thinking, you know what? If I retire, I'm going to die. There's no tomorrow for me. A lot of people say, you know, this saying, I'll die at my desk. Let's hope that's not you. A lot of sellers also think, if I'm not here, what are my clients going to do? Without me, they can't make a decision without me, because I've been there for them from day one when they started their business, when they did anything. And also the seller is thinking, well, if I merge, will I still have control over what I do? I'm right now the master of my own domain. I don't want to lose that in the future. But you know what? If you get the right successor, you ask the right questions, that will not be an issue. Now, when you're looking at other practices to merge with or to have somebody take over your firm, you want to make sure that they have similar billing capacities as you do. Now, we know a lot of people today are doing value billing. There are still people doing hourly billing. If that's going to cause a problem with you, that's not the right merger candidate for you. That's not the person to take over your firm and pay you for your sweat equity when you leave. What's important is receivables. You know, a lot of people are not careful with their receivables. I just met somebody who said, oh, my receivables are only 10% of what I bill out a year. I go, my God, that's great. I said, that's probably the worst part of having an accounting practice, is that you just don't get paid right there on the spot. So if you're going to partner with someone, you want to look at that. You want to see what their cash flow is. You want to see if they have retainers. You know, that may be an important thing. If you have clients who are used to a retainer bill, and all of a sudden the successor firm comes in and changes all of that, you may lose them. And most sales of businesses, the monies that you're going to get is going to be based on the retention. So you don't want to upset the apple cart with those clients that you had. And also you want to look at what is the profit of your clients. What do those clients mean to you? When you merge with someone else, will they handle them in the same way? Some other things that you may want to consider: what kind of equipment do they have? Are they in the cloud? Are they paperless? You know, there's a major cost to doing all of this. One, they may be accepting to do this, but Do you want to be a part of it, or are you still paper for everything? You know, I met a CPA who's been in business, very successful. He doesn't even turn on his computer. He's so used to what he did years ago on paper, and he's extremely successful. But you know what? He's got the right staff to do everything. So it doesn't matter that he's aging and he doesn't know how to do the programs, because at least he's smart enough to get the right people around him. Something that always happens with owners of CPA firms is you're all numbers people, and you want to get the best lease possible. Well, if you go somewhere, let's say you have a magnificent suite of offices, and you say, oh, I've gotten the greatest deal in the world. I got this 10-year lease, and look at the location I'm in. This is going to be great, and I'm paying less than anyone else in this area. That's fine, well and good, but what if you're going to merge with someone, or you want to sell to another firm, and they don't like that location, or they have a location that's even twice as large, and they want to use that location? Now you shot yourself in the foot, because you won't be able to get out of that lease. You also want to consider who your staff is. Some practitioners say, my staff has to go with the practice, whoever I sell it to. And some will say to me, you know what? If they have really good people who could work on my clients, the new owner does not have to take my people. Something you may want to consider also, that new firm may be able to provide new services, and then there's fee increases. Perhaps you'll refer clients in there and get paid for your rainmaking activities. So you have ways to make more money, even though you're in your succession plan. Now, make sure when you do this, you make sure whose role is being, you know, mainly you're the one who does most of the work, unless you're like that one client I said, the staff does everything. It's so great what they do for them. You want to make sure that it's either you or those other people's roles can be replaced by the other company. Why? Because if you don't do that, if you're not ready to do that, you're going to lose those clients you had for all those years. You also want to consider the difference between brand loyal clients versus partner loyal. You know what? Some of your clients are there because of you. Unlike the larger firms where they're there because of the name of the firm. That's called brand loyal. So know what the difference is. I think for most sole proprietors, which we have on the call today, I think those are what we call a partner loyal clients. Now, when you're looking to transition, give yourself at least 2 years to transition your practice fully into the other successor firm. Now, why is 2 years important? When I started out in this business 35 years ago, I used to go to my clients in a certain section of town. I would do their monthly work. And when I left at the end of the day, I also wrote myself a check, which was nice. Now that doesn't happen. Yes, I may speak to that same client a couple of times a week, but I don't drive there anymore. Maybe in 2 years, I only see them 2 times. What's important about this is that way, since it's a different world today, that way the clients don't feel like you've abandoned them, that you're just pushing this new person on them while you're trying to work less hours, because they got you. Years ago, it was a different subject. But now, you also want to look at the client's fears. They want to know who's the one who's going to come and see them, who's in the firm, and these are all things you have to look at when you're looking at succession. Now, also, can you provide the necessary replacements for all of your partners in time? Or, actually, I did have a situation where it wasn't just the sole proprietor who was retiring, it was 2 of his staff people. So you have to look at that also. So there's a lot that you have to think of there. Now, a lot of firms are also looking to do their succession internally. Normally you see the internal succession in the larger firms because you have so many people there and you have the various talent. If you're a sole proprietor, you may not have that many people there that you could, number one, trust to pay you the payments, and keep the clients so that you get paid. So it's a little different. But if you do have someone that you have grown for years, it could be the best thing that you could do. Now, of course, there are people who have, let's say, their children or relatives that are in the business, and they can internally sell to them. Now, if the internal succession doesn't work, you have a couple of options. First of all, you may want to take a portion of your practice and you may, what we call, cull it out, take it out, sell that separately. Or perhaps you're going to consider doing an upstream merger. And with an upstream merger, you have that ability to be with a larger firm than yourselves, and you do not have to worry about the fact that you did or didn't have the internal or the bench, so to speak, to fulfill your succession plan. And we have another polling question, number 2.
Okay, the second polling question is on the screen. This one is, which best describes your personal situation over the next 5 years? And you can see your options there. You're either seeking to reduce your commitment, you are interested in acquiring a firm, probably not the partners option given the audience, or none of the above. Okay, I'll go ahead and close the poll. Marcia, we've got a pretty even split between seeking to reduce time commitment and interested in acquiring.
Okay. Oh, so we have buyers as well. Okay. And these rules are applicable to whether you are the acquiring firm or you are the firm looking for your own succession. Now, a lot of people ask how to value the accounting firm when you're selling on the outside or if you're selling to partners. There are 5 variables that we want to consider. Number 1, cash up front. You know, years ago, that was the big thing. Practices were being sold for a certain amount of cash, and the person could just, like, it was an immediate sale, they could just run away into the sunset and enjoy themselves. Right now, especially in the Southeast market, we're seeing maybe a down payment 10, 20% max. We're not in today's world seeing that cash up front as we did years ago. Also, it could depend on what time of year you are selling your business, because we all know, based on tax seasons and deadlines, we have more cash flow different times of the year. So you have to look at this. You have to look at how long are you aging your receivables. If your clients are paying in and on time, that's great, but we do know that in this profession, receivables are just a fact of life. And you want to know how long it's going to take that buyer to recover the money that they put in there. It's a lot of money that goes into there. I mean, let's say they want to link all the computers between one office and your office. They're using you as a satellite office. That's very common. There's a cost in that. If you're not in the cloud and they are, there's a cost in doing that. Converting your tax programs. These are all costs that the acquiring firm would have. I mentioned a retention clause that's really important. That's the guarantee for your payments. You want to make sure that those clients stay there. And this is good for both the buyer and the seller. Normally we structure deals where the seller is paid out of the retained clients and the monies that come in every month. That way the buyer's not hurt. It's not as much cash to come up with up front, and the seller has continued payments because they're making sure that those clients stay there. Okay? So that's something you want to look at as well. You also want to look at the profitability of the billing rates being charged. If you have an audit firm and you're charging those particular audits the same as you were charging your accounting clients, there's something wrong, because we all know more and more, but it could create a problem. And whether you're the buyer or seller, you'll look at the profitability, the net of all that's being billed out there, and if it's being done at the rates that the market would bear in your particular city. And when we're talking about, most of you, I believe, on the call today are from Florida like I am, when you're talking about the bigger cities in Florida, it's so much different than the out-of-town areas. Also, what should be considered is the difference between the deal structure that you want. If you want a goodwill transaction, that means the buyer is going to have to amortize what they've paid you over a 15-year period of time. If you agree to a current deduction, in other words, a consulting agreement where you got paid year after year, at least the buyer can deduct that over, the most common is over 5 years. They don't have to wait to take the expense in all the years if you asked only for a goodwill transaction. Also, length of the payout period. As I said, the most common we see is 5 years, but you know, it could be less, it could be more. And if you as a seller are willing to wait longer to get paid, let's say instead of 5 years, you say, okay, I'm still going to work, but I'm going to work at reduced hours. I don't want the admin responsibilities, but I'm willing to wait 10 years to get my payments in full. Yes, I'll get paid for the hours that I work, and that's usually 1/3 the billing rate, but I'm willing to wait longer to get my payments. I don't need it today. If something like that happens, then the multiple, or what you'll get for the practice, is going to be higher because you're allowing the buyer longer to make all those payments. And as I said, there's the multiple that we talk about. That's the most common question people ask. What's the multiple? And the multiple in Florida, we've seen on average, it's about 1 times gross. But if you extend the time, you could get more. But you know what? Things are changing today. I'm actually seeing less than 1 times gross in a lot of circumstances. And of course, it all depends on the buyer or the seller. And of course, it depends on where you're buying that practice. And then, of course, it depends. Only tax clients, or just the traditional accounting? Different type of billing system that you would have for the 2 types of clients. Now, there are certain ways that you can price your deal. You may decide to do it as a multiple of your billings, or there are cases where we've had a fixed purchase price for the particular practice. When you have an internal sale, almost always That's when you're selling to someone on your bench. Almost always it's going to go for less. We're seeing this happen. I mean, the internal staff that are there, they know what the real profitability of the practice is. And I'm not saying they're taking advantage of the owner, but they know how far they can get away with things. And we see that happen. When we're talking internal, you have to look at certain clauses. You have to make sure that you account for death or disability of those parties that are going to take over. Because don't forget, the selling partner or selling proprietor wants to get paid for what his practice is worth. When we talk about external sales, you don't have as much of the emotion that you would have with selling to, whether it's a relative or somebody on staff that you've groomed over the years. The external sale, thus, is known more like a business deal, so to speak. And that's why we see they get more money. So here's some things regarding sales, internal versus external, but with our audience today, I don't think this applies, but it may apply in the future, so I just wanted to give you that information there. Now, we have different ways of structuring the deal when we're talking about external sales. You can have a straight sale. Perhaps you're going to buy into a practice in order to buy out later. We see this with the larger mergers. And this is where the buyer opts in on an interest into the firm. They may not even bring clients into the new entity, but they're buying into a buyout. The mergers, which I spoke about, you can have a call-out sale. Maybe you are merging with somebody who doesn't have any HOAs, and you have a substantial portion of your practice, it's HOAs. So maybe you'll sell that to someone else, and all the tax clients you'll merge into another firm. And then, of course, we've got the two-stage deals. And in a two-stage deal, you're actually selling your equity, but you're staying on for longer. You're making sure the clients are retained and you get paid from what is collected. Now, when you decide to do your plan, you need a roadmap. And here, what roadmap from the start to the finish of this plan. We call this the 7 steps in a deal. And whether you're the buyer or the seller, there's a varied type of step here, but basically it's these 7 steps. What we first tell you to do is to develop a practice summary that explains all the goals you have and what you would like a deal to look like. It can be very simple. We've done it where it's a 1-page summary. It tells information like how many clients drop off information at your office each month. Maybe yours is all in the cloud. They just send it all in. You don't know. That could be very attractive to a given buyer. We'll list sometimes the 5 top clients that you have, not by name, but by industry. This is something a buyer might be really interested in. HOAs. If he finds out your largest client is this large HOA or your top 3, they may shy away. The buyer say, I don't want to look at that. And you'll give information about your staff, how many you have, and the most important thing is you'll tell what your net is. This is something the buyer wants to know. And this is something that's important to you when you do the deal because you want to make sure you still get that net when you start out and do the deal. Organize your must-haves. Know what you have to have in the deal, or else you're not going to do it. This could be the culture. I had somebody who said to me once, I can't merge with that client because they're suit people. Suit people meaning, I guess they never had a dress down Friday, which is so common here in the Southeast. But they actually wore suits and ties to work every single day. And my client said, I love this person, I want to merge with them, but I'm not a suit person, and there's just no way. So know what things you have to have. Know that whether you want to, I know in Atlanta they tell me there's a big difference from being outside the corridor of, I believe it's 285, or being in downtown. The two don't mix. You're either going to be outside or you're going to be inside. And that's a must-have. Identify what you want your partners, new partners or owners to look like. Maybe you'll look at certain skills that they have. You'll look at how large their practice is right now, the location where they are. And once you know these basic things, then you don't have a lot of meetings, because you're going to know up front whether the chemistry is there or not. And you want to narrow the field of who's out there that might be interested in doing a deal with you. And then if it's meant to be, go right into due diligence and then go to the lawyers and close the deal. Don't get them in the beginning, because you may lose a lot of time with them in the beginning. Now let's go to polling question number 3. Nikki?
Okay, the third polling question's on your screen now. This is about which issue you see affecting your practice most in the next year. So take a moment to read through the answers there. I'll give everyone just about 10 more seconds to indicate their answer. And again, as Marcia said, this is the third polling question, and to get the full 1.2 CPE credits, you'll need to answer all 4. Okay, I'll go ahead and close the poll. It looks like those on the call are most concerned about a need for growth.
Okay, very good. Now, in every business deal, and you've seen it with your clients, and now you're thinking of doing one for yourself, there's always roadblocks that you should anticipate. So in this next section, I'm going to tell you what some of them are and how to overcome them. First of all, time. Have you heard the saying that time kills all deals? And it's true. It really is true. You know, you're sending a bad message if you spend too much time on something. The bad always comes out later on. Joel Sinkin, president of this company, tells a great story. It's the tiramisu story, where he has 2 clients, buyer-seller, who are going out to dinner. They're congratulating each other. They're doing this deal. And the waiter comes over and says, oh, I have, this is what I have on the menu. I have tiramisu tonight. And so one of the parties to the deal said, no, I don't want the dessert. Let's just get the check. And then there's a fight over the check, back and forth, back and forth. And then the buyer decides he's gonna pay for it. When the buyer decides to pay for the check, then all of a sudden the seller says, you know what, I'm going to give her tiramisu. And you know what, give me another one for my wife to take home. And you know what happened the next day? The next day the client calls Joel and says, you know what, that guy waited till I offered to take the check. And once I offered to pay the check, not only did he order dessert, but he ordered one for his wife. That's not somebody I'm going into business with. You can have these things happen. I had a client who said, you know what, I'm not going to meet this person that you want me to meet. I gave great people for your practice. Oh no, that managing partner plays golf at my golf club, and if that's how he plays his game, there's no way I'm ever going to let him near any of my clients. I'm not doing business with him. And the more time you have for these things come together, that's why time kills all deals. Also, if you have an agreement between the two of you, if you keep reading it and reading it and reading it over, the last time you read it, you may find something. I'm not doing the deal. And the most common thing is if somebody in your given location or city gets wind that you are selling, maybe competition will come knocking on the door. Hey, I heard you talking to ABC company. I could do a better deal with you. I have what you need for your succession plan. So that's something you got to look at also. Change is a tremendous roadblock. A lot of people don't like change. But a lot of people like that the successor firm has more financial strength than they ever would have had. Maybe they have more professional staffing people. I know someone who only recruits his staff from the Big Four. Maybe that's something you want. Or maybe you don't want the overhead of that type of staff. That's change. Ethnic, language consideration. I'm in South Florida. We have an extreme diversity of a lot of people. For a lot of people, it becomes a language barrier. But you know what? It could be a plus. If you have, I just heard somebody recently, he said that he knows both French and Spanish. Well, we don't have a lot of French companies here. I mean, if you were in Montreal or somewhere in Canada, that would be a plus. But you know what? It could be a plus if you're merging with a firm from Canada, which is mainly French, with a firm here, and at least you both can swap clients back and forth because you do have that language capability. Something else you may want to look at is how old are the partners or the new partners that you're going to have. Will they be there to take care of your clients? If they have employees, are they known? I'm sure you've all seen the list of the top firms to work for, and that's a great survey that comes out every year, and they actually let the employees do a lengthy survey about the managers of these given firms. And it's very important if you are going to merge with one of those firms or sell your practice to them, that you know how they treat the clients. Why? If they treat the employees well, they're going to treat your clients well. If they treat your clients well, then you're going to retain them and you're going to get paid for your client base. And of course, what's most important is, do they have the capacity in order to get the work done that you need? Another thing you got to look at is the transition issues of both the staff and clients. Maybe the staff doesn't want you to merge with someone. I actually heard a staff member tell the boss not to do a deal. Not that that person knew who was coming in. They just felt that they too are going to retire in a year or two. They didn't want to be around for that transition and be concerned about that. It's an issue you have to look at when you're looking to put together your succession plan. And one of the biggest things out there, one of the biggest roadblocks, of course, is IT. Now, if you have a good IT person on staff, that's great. But if you don't and you want to merge with someone who is so up on the latest and the greatest computer programs and systems and the dual screens, and now it's triple screens, that change could be really, really difficult for you, and thus another roadblock. Something that becomes a problem other than equity is the firm's name. Someone who was selling their firm still wants their name there. Now, you can, especially in the state of Florida, I know you can take the old firm and you can put a division of the new firm. But this sometimes is such an important issue to the person selling that it can create a problem in the deal, okay? Also, know, as I told you when you started the process, the 7 steps, know what your must-haves are. Know if you have to keep the staff. These are all things that you need to be looking at. Now, also, what is super, super important is what we call the 4 C's. This is going to identify what is going to be the right successor firm for you. The 4 C's are as follows. You have culture. And it's not just the culture of the people in the office or the partners or the owners. It's what it's like to be a client of that firm. You have to look at that. Whether you know, if you acquire another firm, you want to know the kind of clients they have. You want to know how old those clients are. You're certainly not going to want to acquire a client base where most of the clients are not going to be here in 2 years. That's not the purpose of your merging and growing and acquiring. Okay, so these are all things you want to look at. The other C is chemistry. How well do you get along with the people in charge in the firm? Are they suit people? Or, you know, the other thing that's very good in chemistry, how the office is run. We see today, especially in Southeast, many offices are closing on Fridays. If this is not something you want to have, or if this is a must-have of yours and your staff, and the other firm doesn't do that, that could cause a chemistry problem. Continuity. How will the changes in your operations affect the retention of your clients, especially, and the staff to work on them? And then capacity. Does the firm have the capacity to take on, including replacing you? I just was asked this morning. I was asked by a client who said, well, will me when I am no longer working on all those clients and get the work done? It's a concern. So that particular client is going to look at the staff and the managers to see that there is not going to be an issue, that there is indeed that capacity. And we have a final polling question, Nikki?
Okay, the final polling questions are on the screen, and this is about your most likely succession plan. So, as Marcia said, this is our final one, 4th and final. And we'll give everyone just a few moments to indicate your answer. Okay, I'll go ahead and close the poll and turn it back to you, Marcia, to finish up.
Okay. And what was the results of number 4?
We also have a pretty even split here. So half say finding an external buyer, and then the other not sure. And of course, the sole proprietors, we didn't have anyone say selling internally.
Okay, thank you. But I have to tell you, especially the ones who were unsure, you've made a right step today, because you're on this call today you're learning some of the steps required in putting together a succession plan. So I commend you for doing that. Now, if you happen to need more information regarding anything regarding succession planning, here's our guru, Joel Sinkin, and of course, CEO of this company, Terry Putney. Well, his picture's not here, but they have written so many articles for the AICPA. You've probably read some of them over the course of your practices. We invite you to go and look at some of these websites, or even go on to Transition Advisors website for more information. And if you want to know about a specific city or town where you are, and because you know whether you're North Florida, South Florida, it's a world of difference. So I would be glad to help you with that. So my contact information is here. And again, I welcome you all to our website, and you can look at all the other resources that we have and some case studies. It may apply to you specifically. And with that, I'm going to close for today. Have a good evening, all, and I hope you join us again for other updates in this area of mergers and acquisitions and what you can do for your own succession planning.
Great. Thanks so much, Marcia. Thanks, everyone, for attending. And again, don't forget to do that survey before closing your web browser. Once you've done that, and assuming you answered all the polling questions, you will receive an email from me with the CPE certificate. If you have any questions about the content of the webinar, please contact Marcia. If you have any questions about CPE, you can reach me by replying to one of those reminder emails from GoToWebinar. So thanks again for attending, and have a good afternoon.